All right, so we are at the hour now, and we'll go ahead and get started. So like I said, thanks for joining. If you have a second, please drop in the chat where you're joining from. Always nice to see where we've got people. But we're going to jump right into this presentation today. So today we've got a presentation on cost segregation and how that can help us unlock hidden capital in our businesses and in our real estate. So to get started, I'll quickly introduce myself. My name is Will Whiteman. I'm our senior cost segregation consultant here at Layton. I've been in cost engineering for over 10 years, worked in several different roles there, with most of it coming in cost segregation specifically. But I worked on hundreds of different building types and helped clients reallocate tens of millions of dollars, which has resulted in millions of dollars of tax savings. So really enjoy what I do, helping business owners and real estate investors save on taxes to be able to reinvest that money into their businesses and into their portfolio. Little background about Layton. Layton is an international tax consulting firm, been around for about 25 years. We're in a lot of different countries, but here in the US, we're a specialty tax incentive service line that offers several different incentives on top of cost segregation. We have energy incentives, R&D, SALT, property tax, among other things. So we like to consider ourselves a one-stop shop for all your needs for when it comes to specialty tax incentives, to partner with your CPA, or if you are a CPA, to partner with you to be able to take care of your clients. So today, like I mentioned, we're going to be talking about cost segregation. Here's a little quick overview of what we'll cover. I'm going to do a little quick refresher of what depreciation is and what cost segregation is for those of you that are newer to this service line. And then for those that are familiar with it already, we'll go through some of the recent updates in the industry and some case studies and what the process can look like if you haven't done a cost segregation before, or what it would look like if you did a cost segregation with us specifically, and how that may turn into a partnership for any of those in the financial advisor or CPA service lines. So to get started real quick, I just want to do a quick review of what depreciation is, because this is the key tool that cost segregation uses to provide the deduction amount that we're utilizing to reduce the tax liability. So what is depreciation? Well, simply said, assets degrade over time. They wear out, they get older. This is referred to as depreciation. So depending on the asset itself, it has a different life that it depreciates over. So some things are expected to last 5 years, 10 years, 15 years, 20 years, whatever it may be. And that's its depreciable life, so to say, that it would last before you would want to improve it or replace it. So like I said, this is the main tool that we're using in cost segregation. And just to give you a better idea of what this looks like in practice, typically, even though buildings tend to appreciate in value and go up in value, even though they're getting older, on paper, they do lose value because of depreciation. You're able to write off a certain amount of each asset or building that you have because of that wearing out or that degrading of the asset. So here's a quick example. Typically with a building, if we had $1 million building, it's going to depreciate on a fixed line over 39 years, which means you just take $1 million divided by 39, you get that fixed depreciation amount every year for 39 years, which in this case would be about $25,000. And it applies to several other assets. You know, we've got a vehicle example here. If you purchased a vehicle for $30,000, it's got a life of 5 years. You would take a $6,000 depreciation deduction every year for 5 years until you used it up. But today we're going to focus obviously on real estate specifically, and that 39 or 27 and a half year for residential properties when it comes to depreciation. So these asset classes that we deal with real estate tend to be or are the longest in the tax code. So a lot of the assets that you have in your building are inappropriately being categorized in these 39-year asset classes, which is really long when they should be 5, 7, or 15 years instead. So that's where cost segregation comes in. That's where we're able to unlock or segregate out those shorter tax lives into their appropriate class to realize the tax benefit sooner. So why do we do cost segregation? Well, we do it for the tax savings, to increase the cash flow for our business, and to increase the overall ROI for whatever your goals are, whether that be to invest into more properties, to reinvest into certain aspects of your business. But being able to increase that ROI in your business itself instead of paying that money to the government and to taxes, it really helps businesses grow and scale and hit all those long-term goals. So that's why we do it. We're able to reduce tax liability, increase cash flow, and reinvest into the business. So how do we do it? Well, we do this through depreciation, like I mentioned at the start. And what we're able to do is accelerate that depreciation from that main class life that I talked about, 39 years, into shorter ones like 5, 7, or 15. So this is an IRS approved method. It's been around since the 80s. It's a great way to handle, or it's a great strategy to reduce tax liability for real estate owners. And we do this through an engineering-based process. So everything's looked at individually. Each asset, it's separated out or segregated out, hence the name, and cost is identified and is correctly placed into its correct asset class and tax life, so that you can see those depreciation deductions when you're supposed to. And then lastly, I just want to hit on bonus depreciation, and we'll talk about this in the example, but bonus depreciation is exactly what it sounds like. It's a bonus. So when you take these assets that are 20 years or less, let's say a 5-year asset would typically depreciate on a fixed line over 5 years, but with bonus depreciation, it's a fixed percentage that you're able to take in year 1. So this has fluctuated over the last 20 years between 0 and 100%. We're going to talk about this where it stands currently, because this really makes the cost segregation benefit even more lucrative since it's currently at 100%, because you're able to take the full segregated amount, whether it be 5 year, 7 year, 15 year, whatever it is, and see the full benefit year 1 because it's at 100%. So we'll talk about that a little more. But that's one of the biggest players when it comes to cost segregation. So here's a quick example of kind of what I was mentioning. Typically, you've got your real property that everything starts at in a 27.5 or 39-year class life. Some things we're not able to segregate out and have to stay in that class life, like the walls, windows, permanent flooring, stuff like that. And then we've got a 15-year land improvements, which we're able to separate or segregate out things that you've done to improve the land around the building, like parking lots, sidewalks, site lighting, storm drainage, things like that. And then lastly, non-structural components inside the building or personal property can be segregated out into 5 or 7-year class lives, things like furniture and fixtures, computer equipment, specialty equipment for your business, whatever it may be, can be reduced from that 27.5 or 39-year class life down to 5 or 7. So you can see that's much, much lower. You would obviously get the benefit much sooner of being able to do it that way. So let's look at how this works with our example again real quick. We've got $1 million building. It's depreciating over 39 years. You're taking $25,000 in depreciation deductions every year for 39 years, which is a long time. A lot of people don't own their buildings that long. But if we instead did a cost segregation study and we were able to segregate out 200,000 of that $1 million into land improvements and another 100,000 into personal property, giving us 300,000 or about 30% of it being segregated out or accelerated, that would result in a $317,000 depreciation deduction in year one with 100% bonus depreciation compared to the $25,000 deduction. So you can see that's a huge difference. It's a huge swing, going from 25,000 to 317,000, and would result in significant tax savings and cash on hand to be able to reinvest into your business. So that's at a high level what's going on with cost segregation, how depreciation works, and now we'll get into more of the details of how it can help you and kind of where the market stands currently. So we quickly talked about bonus depreciation, which I mentioned is a fixed rate that's varied over the years that allows you to take a percentage of the segregated amount in year one. And this last year, the One Big Beautiful Bill was passed by President Trump, and this raised bonus depreciation back to 100%, because we originally had it at 100% in Trump's first term through 2022, and then it would start to phase out. It was supposed to phase out 20% by 20% every year until it went to zero. So 2023 was going to be 80%, or was 80%. 2024 down to 60, and then 2025 was set to be 40% until this bill passed and raised it back to 100%. So the One Big Beautiful Bill made 100% bonus depreciation permanent for any qualifying property placed in service after January 19th, 2025. So even though it was passed in July, it was retroactive to January. And this is great for building owners because, like I said, instead of being able to just take 40% of the identified amount in year one, you're able to take the full amount. The full segregated amount is a year one depreciation deduction. Okay. So real quick, let's look at how this would look with our example, our $1 million example, before and after the One Big Beautiful Bill passed, to show how significant the change is for real estate investors and building owners. So first off, we've got in this column the 40% depreciation or bonus depreciation. So if we were able to segregate out that 300,000 again, if we're only taking 40% of that, only ends up being about 120,000. Compared to bonus depreciation being 100%, we're able to segregate out 300,000 again, but we're able to take that full 300,000, giving us a depreciation deduction with the 39-year straight line of 317,000 compared to about 137,000. So it's almost a $200,000 difference, which makes a huge difference when it comes to actual tax savings. So we'll look at this real quick as at a 30% tax rate with pre-One Big Beautiful Bill. In our $1 million example, would have resulted in about $41,000 in tax savings, whereas with 100% bonus depreciation back, that more than doubles, being a six-figure tax savings at 100,000. So very significant with this change of law, and really allows this benefit to, I guess, gives you a bigger benefit sooner, which is a really big deal when it comes to cost segregation, a bigger bang for your buck. Okay, so before I move on to the next part, we're going to talk about kind of who qualifies, who should take advantage of cost segregation itself. I want to pause. We've had a couple questions. Let's see. Will we be sharing the slides? Yes, I think we've got that addressed by our admin team. And then a second question, someone purchased a property in 2021. Can you still do a cost segregation study on it? Yes. So ideally, you would do a cost segregation study in the current year that you bought it. So in this case, if you bought a property in 2025, you're filing for 2025 taxes. It makes the most sense to do it that year because you see the benefit right away. But even if you've bought a property in past tax years, you're still able to do a cost segregation study on it, and without needing to amend your tax return or anything. So there's a form called Form 3115, which allows you to file that in the current open tax year and catch up on that missed depreciation that you would have gotten had you done the cost seg study in the year that you purchased it. So really good benefit there for those that are just learning about cost segregation, even though they've bought properties in past years. So along that note, let's talk about when does it make sense and who qualifies for it. So there's several different situations where cost segregation may make sense. The main ones are business owners that own their building and real estate professionals, so those that are actively, materially participating in investing in real estate. There's a couple other smaller groups that allow you to see the benefit, like short-term rental operators, and as well as people with enough passive income for the passive losses to offset from owning a lot of real estate. So the main thing here is making sure that you have enough income for it to make it worth it. Because if you don't have enough, if you're operating at a loss in your business, you can't take advantage of the deductions because you're not showing profit for tax purposes. So that's a really big one, is just having the income to offset is always a good check. And then being able to qualify as a real estate professional, or having the real estate under the same entity that's you're materially participating in, to be able to use those losses against your income for the business or whatever your income may be. So lots of different situations there, but if you're ever curious, hey, does this make sense for me? We're always happy to provide estimates free of charge to give you an idea if it may make sense or not. So feel free to reach out to us at any point if you've got a property that you're interested in doing a cost segregation study on. So now I want to cover, before we get into a few more details of what the cost segregation may look like in the end, I'm going to cover a couple more examples outside of that simple $1 million example that we talked about. We'll look at a couple case studies that we've done. So a lot of people invest in residential real estate. This is a good example of a 6-unit apartment building that was $500,000. And if we just follow down the lines here, you can see that the total cost to buy this building was $500,000. First thing we have to do is account for land. The land that the building sits on has a value, but it does not depreciate. So we have to remove that amount. And that's a critical part of the cost segregation study, is identifying a correct land value. And then we've got eligible settlement costs to transact the real estate can be depreciated as well. And then we have our total cost of about $434 after removing and adding those other two lines in. So with what we've talked about so far, we were able to identify about $92,000 in costs that we're able to accelerate into shorter tax lives of 5, 7, or 15 years, which resulted in a new depreciation deduction of $91,000 compared to what their year one depreciation deduction would have been. You can see in the pre-study depreciation of $32.91. So pretty significant difference there. I'm assuming that one's, with how small that is, it was probably towards the end of the year on that fixed line amount. But even then, getting about $100,000 in deductions for your property year one with 100% bonus depreciation is about a $30,000 tax savings at a 30% tax rate. So really great value there. And secondly, another example, really common in the commercial world for business owners, is an office warehouse space. This particular example is $1.6 million. Again, we've removed the land value of $264,000, giving us a analyzed amount of $1.3 million. Of that, we were able to segregate or accelerate $235,000 in costs, which resulted in a new depreciation deduction of $211,000 for year one. So you can see the pre-study depreciation. I'm assuming this, with how big the difference is there, might have been from a past tax year, maybe a year or two before the current open tax year. Hence the difference from new depreciation to net new depreciation. But even then, on a $1.6 million purchase, you're able to get over $200,000 in deductions. to reduce your business's tax liability, buy more equipment with that money, reinvest it into another location, whatever it may be, upgrade your current facility. There's really a lot you can do with having that cash on hand instead of, like I mentioned before, paying it in taxes. So this one's kind of number heavy, but I just want to point out maybe the top line. We've got a kind of the difference of before cost seg and after cost seg. So the third column there is pre-study depreciation expense. So for this building, you would have got $34,000 as depreciation deductions every year for 39 years. Or with the cost seg, you get that $251,000 year one, with the straight line amount only dropping about $6,000 to $28,000. So you're still getting that straight line amount because we can't segregate every cost out. But you get that huge year one benefit, which is a really big deal when it comes to, the time value of money. If anybody could go back 20 years and have cash on hand to buy real estate, they would do it. With how properties go up in value, with what happens in real estate, it's a pretty safe play to say that anybody would go back in time because of the inflation, how the dollar's kind of deflated, lost its value. So investing that money today instead of waiting 20, 30 years is significant when it comes to your overall ROI. Okay. So a couple case studies covered. Next, I want to kind of talk about whether you're an individual investor, a CPA, financial advisor, CFO, whatever you may be, and what you should look for properties to do a cost segregation study on, what you should look for to not do a cost segregation study. And before we move on and talk about this, we got another question about cost seg increasing audit risk. Does it increase audit risk? And curious why my current CPA hasn't recommended cost seg. So good question. So the first one is no, this is handled, like I said, IRS approved. If it's done in the right way, you're allowed to take these accelerated depreciation deductions without it raising a red flag. So, and even if you did get audited, if you've done it right, there's not going to be any problems. Secondly, why hasn't my current CPA recommended cost seg? That's really common. We see that a lot. A lot of CPAs aren't working, either specifically in real estate or in specialty tax incentives. They're more focused on preparing taxes or whatever it may be. So while they haven't handled this themselves or been familiar with it, that's really no fault to them. It's just it's something that they may just not have been as familiar with. So a lot of people just don't work in that field as detailed. So I wouldn't see it as a problem, and we're not your CPA's replacement. We're just kind of an extra resource. So being able to bring us on board to assist your CPA in these specialty tax incentives like cost segregation allows you to take advantage of more tax savings and reduce your tax liability in the end. Okay, so on that note, what's a good situation where we can take advantage of cost segregation and maybe when to hold off. So what we recommend is if you've purchased, built or renovated a building, those are the three main triggers for $250,000 or more, it may make sense to do a cost segregation study. And the other thing, if you're planning on holding the property the 3 to 5 years and you purchased it within the last 5 to 10 years or so, if you check those boxes, it may make sense for you. And lastly, if you have taxable income, like I mentioned before, if you can't take advantage of the deductions, it doesn't really make sense to pay to have a study done if you're not paying any taxes anyway. The reason we mentioned that you're going to plan on holding 3 to 5 years is so you can really see the benefit of having that cash on hand and reinvested. There is something called depreciation recapture. If you were to sell really soon after doing the study, you would pay a lot of those taxes back. We won't get too deep into that, but it is something to watch out for, which is why we recommend that you plan on holding the property. If you're that kind of leads into when to hold off. If you're only planning on holding for short terms, a year, if you're flipping properties, things like that, we would recommend not doing a cost segregation study. And along those lines, the other points we have here, if there's just not a lot of basis in the property left, well, because you bought it several years ago, or it's not worth very much, it's in a high land value area, or you just don't have enough income to offset, it would not make sense to do a cost segregation study. And we're pretty transparent about that. We're happy to provide estimates and quotes for people. And if it doesn't make sense, we'll make sure to tell you that. We don't want someone paying for something that's not going to benefit them in the end, because that's all we're trying to do in the end is provide an additional benefit to your tax plan to be able to reduce that tax liability, keep that cash on hand for you if it makes sense. Okay, so finally, we've kind of covered what it is, who it may make sense for, and lastly, I just want to talk about what the final product looks like and how it's integrated into what you may be used to as a CPA filing taxes, or just as a client looking to incorporate this additional incentive into your tax plan. So for us, when we provide a final cost segregation report, we go through, take your building, we analyze it, we accelerate and segregate out certain assets. We generate a report based on the IRS audit techniques guide and all the things that they're looking for, and the key elements that they want to see in a quality cost segregation study. They lay all those things out for us, and we make sure to check all those boxes so that you get a really good report. But you'll get two documents, and the first one is that report that I mentioned, basically laying out that, hey, we followed everything the IRS wanted us to, and this is how we did it. And the second part is the engineering analysis with the cost segregation study schedules that shows, how much was segregated out into 5-year, into 7-year, and 15-year. This is a really easy reference for your CPA to pull from to build the new depreciation schedule and generate that those accelerated depreciation deductions for you to take advantage of. So yeah, two pieces here. They come in PDF format, really simple to reference. You keep the final report on hand if you ever need it. If the IRS ever came looking in an audit, you have it on hand to show that you did it the correct way. Then the schedules you can provide to your CPA for easy reference for their tax filing. And here's a couple examples of what that would look like in delivery. The top table would be a quick summary for the client, showing your total building cost, how much we were able to segregate, and our fee. So it's really simple looking at that you can see, oh, okay, they were able to segregate out $7.8 million. I'm getting a $5 million depreciation deduction for my $35 million building. That's amazing. And it's clearly laid out in that delivery email. And then the bottom table is a little heavier, and this is kind of an updated schedule for the CPA to reference so that they can see what we did and how we did it and what we placed into the different asset classes so that they can build that new depreciation schedule for your tax return. Okay, so quickly, like I mentioned, there isn't a special form that you need to apply the cost segregation study to your tax return. If it's in the current year, you just add those depreciation deductions to Form 4562, as you would with a straight line amount. If you're doing a study for a past tax year, you do need to file Form 3115 with the cost segregation study to catch up on that missed depreciation. We do not prepare 3115s ourselves, but we're happy to assist with your CPA and guide with any questions that they may have. And lastly, when working with CPAs and just clients in general, we do offer full audit support if issues ever arise on the studies. So if you ever audited and the IRS had questions or you had questions, that's included in our one-time fixed fee to defend the study in the future if you ever needed it. Real quick, before we go into the next part about partnering with CPAs, there's a question in the chat. Is there a limit to accelerated depreciation per year? No, there's not a limit, but like I said, you can only go to 0 when it comes to seeing the benefit. So if you had $100,000 in income, taxable income, and $200,000 in deductions, you can only take that to 0. You can't go negative and get a refund, so to say. So you can take your tax bill to 0, and the remaining amount would roll or carry forward to the next year for you to use it. And if you didn't use it all that next year, it would carry forward again. So it doesn't go away if you don't use the full accelerated depreciation amount. That carries forward indefinitely until you use it up. But like I said, it can only take you to 0. So great question. Okay, so here in this last part, like we mentioned, we are not tax preparers. We are not replacing your CPA. We are here to assist and be an additional resource to your tax plan, your tax team, to your CPA. As we focus on specialty tax incentives, we like to loop in the CPA if you've got one or whoever it may be, to work as a team, to be able to communicate what's needed and to apply the cost segregation study to your tax return. As far as CPAs themselves, we love the partnership model. We love to partner with CPAs and work with their clients. We're able to turn around estimates within 1 to 2 days for any of your clients that are curious about getting a cost seg study done. And if it makes sense, we can engage and work through the CPA or work directly with the client with the CPA copied, keeping everybody in the loop, whatever works easiest. We're really flexible, and we do it every different way to make sure that the client gets taken care of. And I kind of touched on that about our process, but it is usually pretty simple. Well, what it looks like when you engage with us is we'd have a quick kickoff to determine your current business situation, the buildings that you own, and kind of just a high level overview of what you're looking for, and to make sure that cost seg will make sense for you and that you can qualify. And then we would do a doc collect phase where we would go through and request certain documents depending on your building and your tax situation to make sure we have everything we need to be able to build the study out. Take us a few weeks to build the study out, where we would then email out the deliverables to you, and where you can provide those to your CPA, or if we're providing to the CPA directly, they can apply it to your taxes and you're able to see that benefit. And then we are available afterwards for any guidance that's needed for filing and any questions that may arise in future years as far as audits are concerned, or any problems that you run into. So we love to work with individuals, business owners, but also any CPAs, any financial advisors, people that are trying to provide as much of a benefit to their clients as possible. We love those partnerships so that we can help you assist your clients in getting as many benefits as possible to reduce their tax liability. Okay, so that's all I had today as far as presenting. We've got some minutes here at the end for questions. Got 10 minutes left. I don't know if we'll need all 10 minutes for questions, but we've got a QR code here that you can can scan and schedule a call with us. If you're an investor, business owner, anybody that owns real estate, that thinks that they may be able to take advantage of cost segregation, please reach out. Like I said, we provide no-cost feasibility studies that will show you your estimated benefit and what it would cost to get a cost seg study done, so that you can determine whether or not it makes sense for your personal situation. And then from there, if it does, we can engage and go through that process I laid out, where we would collect a few documents, have the study done within a few weeks, and delivered for you or your CPA to apply to your taxes. So really good benefit, more lucrative than ever, as far as having bonus depreciation back to 100%. So it really allows you to take advantage of that benefit in year one, instead of without bonus depreciation, still having it spread out over 5, 7, 15 years. Okay. So I think I covered most of these questions during the presentation already. Past year purchases, yes, you can still do a cost seg, no amendment needed. With Form 3115 allows you to catch up on that missed depreciation. No additional audit risk. Cost segregation has been around for a long time, IRS approved, as long as you're doing it the right way, which we are, following the key elements that they lay out. And then a limit to accelerated depreciation per year, and we talked about that as well. No limit. You just want to make sure you can take advantage of it. So it can only take you to zero, since it comes in the form of a deduction. It's not a tax credit. You can't get a refund for it. So it can reduce your tax liability to zero. But after that, any remaining benefit would just carry forward to future years until you use it up. Okay. Got a few more minutes. If anybody has any other questions, happy to answer them. If you want to talk to us directly, get a more personalized call, please scan the QR code, reach out to us, and we can talk through your personal situation and see if it makes sense for you. But I will hang out here for a couple more minutes to make sure that we get everybody covered. Okay. I'm not seeing anything else come in, so I think we'll end our Q&A a little early. Thanks for everyone for joining. Appreciate your time. Happy to have shared a little more about cost segregation. We just got one more question come in. I have a client who wants to know if converting a property to Airbnb, she would be able to do cost segregation against it. Yes. So short-term rentals or Airbnbs would qualify for cost segregation study. I don't know if it was previously a long-term rental or whatever it may be, or a primary residence. In either case, it may make sense to do a cost segregation study. We would want to look at kind of what year it converted, what year they originally purchased. There's a couple moving pieces there, but we'd be happy to provide a estimate for you if you want to reach out to us directly. But definitely a viable opportunity. So any income producing rentals, whether it be long-term or short-term, makes sense when it comes to cost segregation. So great question. Okay. Thanks for the questions, everyone. Really enjoyed talking cost seg. Again, please reach out to us if you have any questions, if you want to learn more, see how we can help you out. And thanks again for joining, and have a great day.